Hi traders, welcome to this trading price action video with me, John, market analyst here at Blueberry Markets. And we're going to talk about the head and shoulders pattern today. Now, do you trade price action patterns? Let me know in the comment section down below. I'd like to know what you guys are trading as an entry rule or an entry criteria in the markets. Now let's talk about the head and shoulders pattern very briefly. You have two types of these patterns. You have the traditional head and shoulders, which is typically a bearish pattern, okay, and then you have the inverse head and shoulders, and typically this is a bullish pattern, okay. So you have the two types of patterns here, the bearish pattern and the bullish pattern. Now what these are doing are just basically showing us changes in that trend. So typically when your head and shoulders pattern forms, the market is in a bullish trend. It's making higher highs and higher lows. But then we get a shift in that sentiment, and what happens is the market comes down and closes or tests near the previous low. We then get a move up, and then the market breaks what is known as the neckline of the pattern. So imagine if you are looking at the silhouette of a person, you have the left shoulder, you have the neck area, you have the head of that person, and then you have the right shoulder, okay. So a little bit of a weird drawing there, but this is how it looks. You've got the left shoulder, the head of the pattern, and then the right shoulder. Two ways you can trade this. You can preempt the right shoulder and try and get an early entry in at the right shoulder, or you wait for the neckline to break, confirming the change in trend, which can then lead to retest opportunities and a move lower. The inverse head and shoulders is the opposite. It's a bullish pattern. So what we're looking for is lower lows and lower highs, and then that to change, completing the pattern there. Again, left shoulder, head, right shoulder. You can look to trade early on the right shoulder or look for the break and retest of the neckline. Now, it's always important to continue the why, okay? And I might call this method the WCS method. The why, the conditions, and the strategy to apply. So why do you want to be involved with the market? Maybe you've got some sentiment reasons why. The conditions, what are the conditions telling us? So in this scenario, when we're looking for a reversal, let's say that you were looking to buy the US dollar, for instance, but you saw that maybe US dollar CAD was trending lower, okay. So what are the conditions? Well, the market is moving in a downward trend, but we were coming into a very big area of support. So what you're looking for is to buy the US dollar, but you've got a downward trend condition. Now, the strategy would be to wait for that head and shoulders pattern to form, or in this case, the inverse head and shoulders pattern. So maybe your entry criteria is to wait for a H&S, which is the head and shoulders. So the market continues down, makes the lower low, pulls back in, creates that head and shoulders pattern. You then have the conditions to be buying the US dollar and against the Canadian dollar, and you can look for the opportunity. So remember the WCS. Look for the why, look for your conditions, and then apply your strategy. Now, going into a couple of live examples here. This is a live example of a head and shoulders pattern where the market has been in a strong upward trend, and you can see we get a head and shoulders pattern. Now, the right shoulder on this pattern is not perfect, doesn't quite equal the left shoulder, okay. It's a little bit lower because the market isn't perfect. You're not going to get these perfect scenarios all the time. And you can see though, once the market breaks out of this area, we get a move to the downside. Now, typically what you would look for is the length of the head to the neckline. You would copy that up and you'd look to target that move in here. Now, on an entry criteria, you could sell that candle close. Stop loss above the right shoulder gives you a bit of an edge in terms of your risk reward ratio. The second idea is to wait for price to pull back into the resistance zone and then look for an opportunity to the downside there with a head and shoulders pattern. With an inverse head and shoulders pattern, you're just looking for the opposite. The market is making lower lows and lower highs. We then get that breakout in here. What you could look to do is buy the breakout, stop loss below the right shoulder, and look to try and target up at another level of resistance. Arguably the better one in this case or this scenario would be waiting for price to come back to the neckline as support. Maybe you could look to buy with stop losses below here, targeting the previous highs there, and you've got an edge in that in terms of the risk reward ratio. So make sure that you've got a strong risk reward ratio when you're trading these type of patterns. Also make sure that you've got your WCS in profile, you've got your Y, you've got your conditions, and you've got your strategy. Okay, so bear that in mind when you go trade in these markets. Thanks for watching this video update. I really hope you enjoyed it. If you did, please leave it a thumbs up and subscribe to the YouTube channel.